Hi, I'm Shawn Turner here in sunny Atlanta at the Hunter Hotel Conference. Sitting here with Dan Hansen of Summit Hotel Properties. Dan, thanks very much for taking a few minutes today.
Thanks for having me.
Absolutely. So I wanted to start off, you guys were really busy in 2013, saw a lot of announcements coming out of you guys. Talk a little bit about how your 2014 is shaping up.
Sure. Yeah, we were very busy and aggressive with acquisitions with properties and new management companies throughout 13. 14 for us is probably going to be a year more of absorption, probably be much less active on the acquisition side, really harvest some of the gains and the opportunities from the acquisitions from 13 and some even as far back as 12.
Do you expect to see that just broadly from the REIT level overall? Do you expect to see a little less activity, from the REIT sector?
I think so. I think activity, the pace has slowed down some. I think it's highly competitive with the public REITs. So I think that's a fair assessment that it'll be less active than it has been the last several years.
When you talk about absorbing the hotels, are you in the middle of a renovation program right now? Kind of what are you doing with the properties that you've acquired?
Yeah, so we've renovated the majority of our same store hotels. Now we begin a lot of the renovations from the hotels we've acquired over the last 18 months. So that is a big part of the story there, the renovation on many of the hotels.
And when you do go out and you're looking for deals, what kind of hotel are you looking for? What catches your eye? And how are you underwriting these deals? How are you approaching these sellers?
I could say we're somewhat brand agnostic. It's got to be a major brand. We really like environments and locations that have multiple demand generators, both business and leisure demand generators. We like larger cities that might be a state capital, might have big corporations. It might be a leisure destination, something that has more than one opportunity to get guests. And then pricing, as you would expect, is always important. As a select service dominated REIT, we look for higher going in yields in that 8.5% to 9.5% range, and that's really one of the things that's core to us getting our returns for our investors.
Are you anticipating selling any properties in 2014?
I think opportunistically, we're always considering selling. There are certain properties that may make more sense for a local owner-operator that may not make much sense for us. We've done a lot of renovations, so there's no properties that we're uncomfortable holding, but as stewards of investors' capital, we're always interested in taking gains where there may be some.
And characterize the transactions environment right now, just generally, for a company that is looking to add numbers to its portfolio. What would they be seeing in the market today?
Well, there's markets bifurcated to a certain degree. There's a lot of larger portfolios from $200 and $300 million to $1 billion, and then there's a lot of smaller one-offs. And some of those one-off transactions might be in a secondary, tertiary market, or it may be in a gateway city or kind of a beltway city, as we refer to them. So they're still in the select service space, which is our primary space. There's still a lot of opportunities from an individual asset to small portfolios, to even $1 billion portfolio.
What about financing? What are you seeing there? And kind of what kind of terms are you seeing as you go out and look for credit in the marketplace?
It's a great question. We watch the financing market very closely. Obviously, it's an advantage for us, because of our size and scale and our strong balance sheet. We can tend to get very good pricing. I think CMBS was really the market that had the most aggressive pricing. But what we're seeing in our experience is that the insurance companies have gotten much tighter in their pricing, comparable to CMBS in many markets. Still seeing leverage, up to 70% in a lot of markets, but you can get better rates by having more conservative leverage down in the 40 and 50% area. So there's still a lot of money to be put out, and for the right borrower and the right project, there's ample credit available.
And as you look out at the hotel industry, what are you seeing? What is your outlook as we move through 2014, 2015? How do you see operating performance holding up, and trends do you see kind of popping up in the industry today?
I don't know that I've ever been more excited, especially after the long list of headwinds we've had. It was Greece, then it was Spain, and then it was Greece again, and then it was an election, and then it was government shutdown. There's always been something, some reason to be somewhat skeptical, and we've gone through and survived all of those relatively unscathed. There's been a slow growth environment. So as I look out, I think there is an opportunity to be more aggressive raising rates across the industry. And I think that will be inevitably the upside surprise if we are able to sustain above average RevPAR. Then many people have predicted that because a lot of that RevPAR is rate driven, a lot of that should flow through and translate into margins. And I think that's really, my view is very optimistic for the balance of 14 and also into 15. Group business is coming back, creating some stability and some compression in the markets. So at this point, we feel very, very, very confident about 14 and 15.